Good afternoon, everyone, and welcome to our webinar. Today, we are going to be discussing a variety of interesting and currently very topical matters related to employee incentive arrangements, distributions by a trust to an offshore trust, employee relocation matters, often referred to as global mobility, and then we'll also be sharing some succession planning strategies with you all. I'd like to welcome our speakers, who are all specialists in their relevant fields of expertise. We have Robert Gadd, Jenny Klein, Barry Kutzer, Megan Stewart-Steer, who are all in our tax team. And then we also have Dion Beechin together with Annika Potgieter from our private clients practice. So let's start the session with employee incentive arrangements, which, although are all designed for a similar purpose, essentially to attract, engage and retain talent, these arrangements can come in many different forms. So I'm going to hand over to Robert and Megan to help us explore some of the intricacies of these arrangements.
Thanks, Anaz, and greetings, everybody. Megan and I are part of a multidisciplinary team which deals with incentives across the African continent. It's an area that's been growing for decades now, and there's a deluge of interest in this area. The comments we'll make today deal with listed and unlisted companies both, but we'll be slightly angled towards unlisted companies because there's some special issues which they confront in introducing incentive arrangements, and I think it's useful to bear those in mind, but most of the challenges will be common to both listed and unlisted companies. So we're going to put up a slide now just summarizing the way in which we approach incentive design, and we need to have a structured approach because these projects can otherwise just take forever. The first thing we do is we determine the goals of the incentive arrangement, and this then helps us inform a decision on the subject matter of the scheme. Essentially, this is, should it be shares or should it be a cash-based instrument? From that, we move into a consideration of the appropriate method of funding the arrangement, depending on whether it's cash or equity-based. And then the next thing we'll move on to is liquidity. How do the participants turn their awards into money? The second last point we have to consider is the what-ifs. Because we put the schemes into place like at day zero, and then we have to plan for the future, there's a wide range of contingencies that we have to worry about, and that typically we will consider under this kind of heading. And then lastly, all of these 5 previous bullets will feed into the appropriate structure to be used for the scheme. There's really no one size fits all. And in the private company space, even more so, it's necessary to come up with bespoke arrangements that work for everybody. Thanks for the slide, Anaz. Let me just make a preliminary comment that we are primarily tax people, but the design of incentives is affected by commercial mixed with tax considerations. And essentially every one of those points on the design slide that were mentioned are imbued with tax considerations. I think most of the people who are in the tax space will be familiar with Section 8 capital C, which is the kind of king of the provisions dealing with share incentive arrangements, but it's by no means the only one. And so essentially we need to have a number of tax considerations in mind as we go through those various bullet points. So in this, we can't touch on every aspect of designing a scheme, but we can touch on some key aspects. So let me start off with the first point, which is the goals. The word incentives is quite loosely used, and it can cover a huge variety of different kinds of arrangements, ranging from the classic widespread employee type scheme with a periodic vesting and monetization of awards. The awards might vest every 1, 2, 3, 4, 5 years and results in essentially a cash payment, when the participants sell the shares. That's the one kind of way in which incentives are used. But the space includes also, because of the way the tax is constructed, would also include investments into a company by essentially a shareholder, but a shareholder who is doing more than simply putting money in. Could also include a kind of a management buy-in and other kind of like almost private equity type plays where there is participation in the business as well. The tax rules are wide enough to cover these, and we have to keep a close eye on all of these arrangements because potentially they fall into the same tax. Won't like to use the word trap, but there can be traps. So we've determined the goals now. And so now the second question is the subject matter, the currency of the scheme. Do we need to use equity, or can we achieve the same result with contractual arrangements and cash? Speaking personally for us, the default case is to use cash for incentive arrangements, essentially to put in place a phantom scheme. The reason we favor that, if possible, is administrative simplicity and tax efficiency. The tax is predictable. But there might be very good reasons to use equity as well. Firstly, could the cash payments put a strain on the business? Will they restrict growth? Will they adversely affect its valuation if there's going to be a deal in the future? Or second reason, is what we're calling an incentive really a kind of founder or investor share rather than simply a form of remuneration? Thirdly, is actual ownership of a share important? For example, if we're trying to achieve BEE goals. Another good reason, this comes up quite often, there's soft or emotional reasons. We often encounter a situation where the founder or the key people in the business have made a promise to their key people that they will share equity with them. And it's difficult to walk back those kind of promises and to give a phantom rather than actual shares. And then a further consideration, which is important, is whether dividend flow is important. And by this, I mean dividends in the technical sense rather than a kind of a manufactured dividend. It may well be that in the circumstances of the company, it is preferable for participants to receive actual dividends and that it's a more efficient way of getting a return on the investment. So any of these factors might lead to the utilization of shares rather than going through a phantom contractual kind of arrangement. It's important that we all recognize that the terms and conditions of any kind of incentive scheme can be replicated in a phantom scheme. There's basically no term or condition that cannot be achieved in the same way. And important, and I think this is not necessarily widely known, but the tax rules, in particular Section 8C, could arguably extend to the phantom type based schemes in exactly the same way as in the equity based schemes. And in fact, we have had instances where SARS have expressed the view that the same type of rules, the same type of 8C treatment must be applied to those phantom type or bonus type arrangements. Interesting point of view and not necessarily widely known. For the rest of the discussion, let's assume that we're going with equity. So let's move on to the next point, funding. In the case of a phantom scheme, we don't need any kind of funding. Funding will only arise if A, we're using physical shares, and B, if we need to get those shares from other shareholders or from the company for a market value consideration. There may well be circumstances where this isn't necessary. For example, it might be that the shares have no equity value upfront in the case of a startup, or it might be a situation where the company is prepared to issue options or other instruments which are delivered in the future for no consideration. But in a case where the participants have to pay for their shares or an entity has to pay for the shares for their benefit, what are the main considerations? Well, to me, there are two. The first one is who's going to take the risk on the equity value. If the debt and capitalized interest potentially grows faster than the equity value does, who's going to take the knock at the end? So that's the first important commercial point. And the second one is, will interest be charged either notionally or actually on this funding? And the important tax point to bear in mind here is that Typically, interest expenditure incurred in order to acquire shares is not tax deductible, but the interest receipt is still taxable to the lender, and this gives rise to a potential tax leakage. This can't really be avoided by giving an interest-free loan because there might still be a deemed dividend arising. So what mechanisms have been developed to get around the problem of conventional interest-bearing funding? Well, there are really three that we see largely used in practice. One is the use of preference shares. In appropriate circumstances, these can be very efficient, but we do have to introduce a vehicle in order to issue those preference shares. Got its own challenges. The second thing that's quite widely used is notional vendor finance. Essentially, it's kind of a formula-based system which puts the parties in the same position as if interest was actually charged, but there is no interest charged. There's simply a formula that's deployed in order to work out the participants' benefit as if they had paid interest on the funding. And a third mechanism that's quite widely used and become quite popular and over time less controversial from a tax perspective is the use of a capital contribution. So in this case, typically the employer company would make a contribution of capital to, say, a trust, and that is utilized to fund the upfront cost of the equity. Appropriately structured, this can have a good tax outcome with a deduction over time, perhaps, for the employer company of the cost of the contribution. And on the other hand, the only tax which arises for the trust or for the participants is the conventional Section 8C taxation on the value of their award. Let me move on to the next bullet point, which is liquidity. Now, what we're trying to deal with under this bullet point heading of liquidity is a few different things. First, we must recognize that there's an idea of commercial vesting. What is that? It's basically when the participant gets the value of the instrument. The second thing we have to consider is there's an idea of tax vesting, which is determined by the rules in Section 8C, and which could very easily be delinked from the commercial vesting. And then thirdly, and this is particularly important when we're dealing with unlisted shares, we've got liquidity. When does the share turn into money? And now we need to try and find a way to link together all three of those events so that there's commercial entitlement to the instrument. It vests for tax purposes, not before, and ideally not after. We don't want it to vest after because the tax cost keeps running until vesting occurs, and we're dealing with income tax being payable on the value of that accretion rather than capital gains tax, which is the position after vesting has occurred. So those are the two vesting points that we're trying to tie together. And then we're trying and tie that to monetization. In the case of a private company, there isn't typically a ready market for the instruments. And so it's necessary, if you want to monetize these instruments periodically, somebody has to make a market. Either the employer must do so, the employer company, or the other shareholders must do so, or some other arrangement has to be reached in order to monetize the shares. This brings me back to the first point, which is the goals. If the idea of the incentive is essentially just to provide a periodic payment every 3, 4, 5 years, one may really go back to thinking about using a phantom scheme. Alternatively, one has to put a mechanism in place to create like a synthetic market for the instruments to provide for the vesting, so as to match up the commercial, tax, and liquidity events. If we can't put that kind of market in place, we reconsider whether we use an equity scheme, or it looks like we're dealing with a situation where outside liquidity events need to occur. For example, a listing, a takeover, an IPO, some kind of event which is going to create additional cash flow. And then what we need to try and do is to match up the commercial vesting and the tax vesting with that kind of future extrinsic liquidity event, so that the parties aren't put in a really quite dangerous position of having tax to pay no money to pay it. I think it's very important that attention is paid to matching up those three events and very, very close review of the documentation. The worst matters that we've had to deal with in the last few years concern the mismatch between expectations about vesting and when it actually occurs. And in a private company setting, it's easy to find that terms and conditions lurking in documents other than the award letter actually create a tax trap for the participant who was not expecting it. They may contain some kind of a restriction, and taking into account here that the kind of restrictions that are contained in Section 8C, some of them are quite counterintuitive. For example, a stop loss provision is a restriction. So we may find in other documents that there is something which actually restricts the share and essentially changes the timing of the taxation and changes the nature of the taxation from what was expected to what is not expected. In other words, changing it from a potential capital gain in the case of somebody who saw their shares as a long-term investment play rather than turning it into taxable income. I would like to move on to the next point now, which is the what ifs. This area essentially involves planning for the future, and these schemes get launched and it's completely unknowable what will occur in the future, and we have to write the terms and conditions in order to provide for the unknown. But with experience over time, one realizes that there are certain categories of events that can play out. We have employee-related events, such as death, retirement, and we could typically call these good leaver and bad leaver provisions, and I don't think we'll spend too much time on those. And then there's a second category, which I think Megan has had land on her desk quite extensively over the last few years, which are, let me call, corporate level events. And I think, Megan, it's worth sharing a few insights on that, if you don't mind.
Sure. Thank you, Robert. As Robert's mentioned, we're seeing incentive issues and particularly upper management level incentive issues arising more and more in our transactional work. And the key issues, again, going back to what Robert has been saying, usually involve managing and balancing expectations, as well as sometimes conflicting commercial goals. So as soon as we see a transaction that is contemplated in respect of an entity which has an incentive plan and especially a management incentive plan in place, we would look to establish, firstly, what are management's expectations? And we look at a few things there. We look at what are their expectations in relation to their awards. Are they expecting a full vesting, a partial vesting, or do they have some expectation that there may be no vesting at all? And then secondly, we look at what are their expectations around the tax effects of that award treatment. Are they expecting income tax? Are they expecting capital gains tax? Or is there some other treatment that they're looking at? We then have to look at what are the commercial goals of the parties to the transaction in relation to management and their incentive plan. And there it comes down to the balancing of those interests. The seller is usually looking to incentivize the exit actually happening at the highest possible price. And that's usually aligned with a vesting at a high price and a maximum possible vesting. The buyer, however, is usually looking to carry on with their management team to achieve some form of continuity. And that's usually more aligned with a remaining in play of some awards, so perhaps a partial vesting or no vesting, or a rollover into a new plan, particularly if an entity is moving into a new group with an existing plan, or possibly some requirements of reinvestment, which Robert touched on earlier. And these issues are especially relevant if the award values are high. And as Robert mentioned, the plan rules don't necessarily expressly cater for the event or the specific type of transaction that is contemplated. So in our experience, this is usually addressed through communication and quick action. A prompt review of the plan documentation, which as Robert mentioned, is not necessarily just limited to the plan rules, as well as a clear understanding of all of the parties' positions in the context of the transaction can go a long way to the best possible outcome. So it's usually advisable to get a team on board to consider these issues as early on in the deal as possible to make sure there's time for those discussions. And Robert, I'll hand back to you to speak a little bit more about how this all comes together in the structure.
Sure. I think we've been very ambitious to think that we can talk about, even scratch the surface of scheme design in the time allowed. And I think it's important that I also acknowledge and stress that the tax people are not the only people in the room. It's essential that we deploy the inputs of a number of other specialist practitioners in our practice area, including employment law, corporate law, regulatory law, and so on, in order to make sure that we've got a well-rounded structure at the end of the day, taking into account all the considerations that we've mentioned, as well as ticking all the other legal boxes. Thank you very much for your time. Anaz, may I hand back to you, please?
Thank you, Robert and Megan. That was very interesting, especially the point you mentioned about the unexpected vesting. So we're going to stay with trusts, which obviously play a prominent role in share incentive schemes, but trusts are also useful for purposes of wealth planning for future generations. And for me, I think this is what makes our next topic, trust distributions, very interesting. If I could ask Jenny and Megan, please would you describe to us all what is this about?
Thanks, Anaz. As you mentioned, discretionary trusts, local and foreign, have been used in the private client space for many years. And the reason for setting up a discretionary trust structure will depend on the circumstances and ultimate commercial goals of the family unit or individual concerned, but they would usually include estate or succession planning. The reason for setting up a foreign discretionary trust structure, often in addition to a local trust structure, may include the need to provide for a global family, i.e. family members in various jurisdictions, the potential future immigration of one or more family members, managing country risk, portfolio diversification, and or the desire to create or externalize wealth. Until now, the usual mechanisms for individuals to fund offshore trusts have been foreign denominated loans, donations, capital contributions, and some other bespoke mechanisms, each with their own complexities and costs. On 1 August 2023, however, an update was provided on the SARS website, opening up the opportunity for distributions of funds by local trusts to non-resident trusts. This statement reads most relevantly as follows. It's been the practice of SARS not to approve the release of funds when resident trusts make distributions to non-resident trusts. Following queries in this regard, SARS herewith clarifies its stance on the matter and confirms that it will consider for approval for the release of funds or amounts distributed to non-resident trusts. The process required to obtain the necessary approval is for the local trust to apply for a manual letter of compliance at SARS by email. SARS has taken note of the fact that the Reserve Bank has relaxed certain exchange control requirements, but has decided, based on the risks involved, to introduce the above-mentioned requirements to mitigate the risks. Following the release of the statement, trust-to-trust distributions, i.e. distributions from local trusts to foreign trusts, have been a useful mechanism to consider when looking to externalize wealth from existing South African trust structures. And I'll hand now to Jenny to give you a bit of an overview of what the processes involved look like.
Thanks, Megan. So the South African trust that wishes to make a distribution to a foreign trust has to obtain the approval of both SARS and the Reserve Bank in order to achieve this. So essentially it's a two-step approval process. But before the trust can apply to SARS for approval for this arrangement, there's a few building blocks that need to be in place. The first one is that there needs to be a foreign trust structure in place. So if there isn't an existing structure, that needs to be established, because the details of that foreign trust have to be disclosed to SARS. The next point is to review the trust deed of the South African trust to make sure that that permits the distribution of funds to an offshore trust, and specifically that offshore trust. So that trust needs to be a beneficiary of the South African trust. And the third aspect to consider from a planning point of view is how the distribution from the South African trust to the foreign trust is going to be funded. So are those funds currently in the trust, the South African trust, or do they need to be transferred into the trust from some other source? And it's a key element of the application to SARS for approval for this, that the source of the funds needs to be clarified and details have to be provided to SARS on that. So once all of that is in place, the South African trust will apply to SARS, as Megan mentioned, for a manual letter of compliance, approval international transfer, so AIT application. And there are certain specific requirements that SARS has when it comes to what information needs to be provided by the South African trust as part of that application. So the first and most important point is the source of the funds to be distributed, as I mentioned. SARS will also only allow a distribution to be made to a foreign trust if the South African trust can confirm that any applicable taxes that will arise as a result of this distribution will be settled or have been settled by the trust concerned in South Africa and any other entities that are involved in the funds to be distributed. So there's quite a number of SARS also will not allow and will not approve a distribution if it's contrary to the provisions of the trust deed of the South African trust. So as I mentioned, that's an important consideration when applying to SARS. There's a list of documentation that will be required to be supplied to SARS as part of this manual letter of compliance application. And in the case of a trust-to-trust distribution, that includes things like the trust deed of the South African trust, the details of the foreign trust to which the distribution will be made, the letters of authority of the South African trust, its financial statements, its all bank statements if their funds are sitting in the trust currently, portfolio statement if that's relevant, and also a copy of the resolution by the trustees of the South African trust authorizing the distribution to the foreign trust. Importantly, the source of the funds to be distributed has to be explained to SARS in some detail. If the funds are not currently in the trust, then one needs to explain how those funds will eventually arise, will be placed into the trust. If SARS approves the manual letter of compliance application, they will issue that authorization, which will be valid for 12 months. And the trust will then provide that to the authorized dealer as part of the second step in the process, which is whereby the South African trust must apply to the South African Reserve Bank for approval to make the trust-to-trust distribution as approved by SARS. So the authorized dealer of the South African trust will utilize the manual letter of compliance when, subject to SARB approval, the funds are ultimately transferred from South Africa. So as I mentioned, the second step is requesting approval from SARB, and that is in terms of a provision of the Currency and Exchanges Manual for Authorized Dealers, which essentially permits offshore investment by an individual via a foreign domiciled and registered trust. So the application to the SARB would be made by the South African trust that wishes to make the distribution to the foreign to the SARB, and it would have to include details in particular, as was disclosed to SARS, of the source of the capital for the funds that will be distributed. So the South African Trust is the applicant in both of these applications. The South African Trust must also provide details of the assets that the offshore trust is going to invest these funds in. And what we've seen is that one of the conditions of the approval of the SARB of distributions of this nature is that an annual portfolio statement showing the assets of the foreign trust and their current market value may have to be provided to the SARB on an annual basis. The authorized dealer might also require other documentation from the offshore trust, such as financial statements or portfolio statements as well on an annual basis. The last point that I just want to mention on this process, this application process and approval process, is that it needs to be considered whether the payment to the foreign trust constitutes a reportable arrangement, as payments of this nature are included in the public notice, which lists certain arrangements which must be reported to SARS. So that's an aspect that just needs to be considered at the time. That's all from my side. Arnaz, I'm going to hand back to you.
Thank you. Thank you both for unpacking that. I see that we have some questions on this topic, and we'll take a few of these at the end, time permitting. But right now, we are going to talk about one of the most significant shifts in the workforce, the rise of remote working. Just a fun fact, the largest generations in the workforce are currently millennials and Gen Z. And according to a survey that I read, 84% of millennials and 74% of Gen Z want more remote working options. So with that said, over to you, Barry.
Thanks, Arnaz. Good afternoon, everyone. In my session today, I'm going to highlight some of the more relevant and common concerns facing both employers and employees from an employment tax perspective, where employees cross borders and render their employment services to their home employer from those foreign countries. I'll be dealing with both outbound employees of South African employers who render their services to the SA employer from a foreign country, as well as inbound employees of foreign employers who come into South Africa. Many of the points that I'll touch on today are not new concerns, although there are a few new concerns which I'll touch on. But we think it's nevertheless good to remind everyone of these factors, particularly in the post-COVID times, where these types of remote working arrangements seem to be much more prevalent than what they perhaps once were. Time won't permit in this presentation to get into detailed discussions in respect of the matters raised. So the intention today is just to shine a light on some of these areas, and also to note that I won't be dealing with formal secondment arrangements in terms of well-established practices and policies of employers that have been in place for many years and where most people understand what the implications are. So today we're talking more the sort of informal kind of arrangements, as we've seen, as I say, post-COVID, where people pop up in strange places, sometimes with the knowledge of the employer, sometimes without the employer's knowledge. So looking at it first from the point of view of an SA employer who's got employees sitting in foreign countries, rendering services to them from the foreign country. The first point, and you'll see some common themes as I go through the various scenarios. The first point is, how long is the employee going to be abroad working for you? I mean, clearly, if somebody's going to be there for a couple of weeks on a short business trip, I think most people understand the implications of that, and those aren't the situations that already form the basis of the discussion today. But more situations where employees could be sitting abroad for 3 months, 6 months, a year, potentially longer, but still rendering their services to the South African employer from the foreign country. As I said, since the employee remains employed by the South African employer, and consequently gets paid by the South African employer, there's some South African tax implications as well. Section 10102, which most people hopefully are aware of, the exemption for foreign earnings, has to be taken into consideration. Is the person going to be spending enough time abroad to meet any of those exemption conditions, and if so, what are the RP5 coding requirements for that foreign income, etc. But again, I think the South African tax implications, employers tend to be on top of more often than not, in my experience, although that shouldn't be taken for granted. But perhaps the area that it seems that employers are less conscious of, for whatever reason, are the possible tax implications for the South African employer in the foreign country, because they've now got an employee sitting in the USA, in Australia, and wherever it is, Nigeria, and rendering services to them from a foreign country. So what implications does that have for the South African employer? Do they have to register with, for example, the foreign country's revenue authorities, because they've now got an employee earning remuneration in a foreign country? What about foreign social security? Do they have to withhold in foreign country employees tax, never mind South African employees tax, but do they in fact have a legal obligation to withhold monthly tax from the remuneration and pay that over to a foreign revenue authority? Some of the other considerations that it seems employers sometimes don't think about: if you've got an employee sitting in a foreign country and something were to happen to them, one obviously hopes that doesn't happen, but people tend sometimes not to plan for the bad events. Will they be covered by the company's group life policy or income protection or disability policies if something were to happen to them while they're working abroad? Can they still remain members of the retirement fund if they're not rendering services in South Africa anymore? The answer to all of those might be yes, but don't assume that that's the case. Check with your fund providers and advisors, and make sure that people are still covered while they're abroad. Labor law implications: if there's a labor dispute that they're sitting in a foreign country, whose labor law applies? Do they have the correct and appropriate immigration position in that country? Do they have the right visa to be working there? It seems that sometimes employers think that that's the employee's problem, and it may well technically legally be the employee's problem, but obviously as an employer you want to avoid your company's name getting across the newspapers or the press in the foreign countries being someone who isn't compliant with local laws. So the bottom line in these circumstances is that we strongly recommend that if you are going to have employees sitting in foreign countries rendering services to you from there, is that you get appropriate advice in respect of the foreign tax obligations of having employees in those countries. Obviously, South African implications as well, but as I said, those we tend to understand better, but the foreign country obligations will vary from country to country. So it is important to get specific advice of what the obligations are in respect of that particular country where you've got employees sitting. Then from the employees themselves perspective, again, how long will the employee be in that foreign country? And what will their tax position be in that foreign country? Will there, for example, be any tax treaty relief in respect of their salary while they're working in that country? That will largely depend on how long they're going to be in that foreign country, whether there'll be any treaty relief. Assuming that the country that they have gone to is a country with which South Africa has a double tax agreement in place. Will they become tax resident in that foreign country? And if so, what does that mean for the employee? Some countries, if your intention is to be there for longer than 6 months, you become tax resident from day one in that country. And so what does that mean? Does that mean that your worldwide income now gets taxed in that country? What if you are paying tax in that foreign country and you're also paying tax on the same income or capital gains in South Africa? What does that mean? Can you claim foreign tax credits? Where do you claim foreign tax credits? How do you claim foreign tax credits? So if you're paying tax in both, could well be tax or cash flow implications as a result of that. Will the employee, for example, cease to be tax resident in South Africa as a result of the time that they spend abroad? And if that is the case, what are the implications for them as far as that's concerned? Will they, for example, have to carry a CGT exit charge in respect of the deemed disposal of assets if they cease to be tax resident in South Africa? Will they be tax equalized by the employer in respect of foreign taxes? In other words, if the tax they're paying in the foreign country, if they are taxable in the foreign country, is more than the tax that they would have paid in South Africa, will the employer equalize them on that, or is it just too bad, too sad, and the employer's got to bear that additional cost? I assume that will depend on whether the reason for the employee being abroad is at the employee's request or the employer's request. But the important thing is that these are aspects that need to be considered in these kinds of arrangements. And again, from the employee's perspective, our advice would be to get advice before they go, so they know exactly what their tax implications will be in the foreign country and South Africa for that matter, so they can plan accordingly, and if necessary, divest themselves of interest in assets if that's what's required. That needs to be done most likely before they become tax resident in the other country. So again, very important to get that specific tax advice in the foreign country. So what about situations where the foreign employer sends or either sends the employees to South Africa, or the employees just choose to come to South Africa and for the sunshine or family reasons or whatever the case is, and so they spend time in South Africa working for the foreign employer. Now this is an area where there have been some changes. Most notably, the end of last year, the definition or the requirement to withhold employees' tax was amended. And so any foreign employer who operates through a permanent establishment in South Africa now, in fact, has an obligation to subject salary payments to that foreign, by that foreign employer to the employee in South Africa, to South African PAYE. So again, important question is, how long is the employee going to be in South Africa? And could their presence in South Africa, in fact, create a permanent establishment for their foreign employer? Because if it does, then that employer has a PAYE, South African PAYE withholding obligation. Or in fact, does that foreign employer already have a PE in South Africa? So again, a consideration there for what the foreign employers' obligations are in South Africa. Just by the way, there's always been an obligation on foreign employers who have employees in South Africa to register with SARS as an employer. But there's never been a requirement to withhold PAYE, although there has been SDL and UIF obligations, and there's some complications around that and practically how that is dealt with. But now there's also a PAYE obligation on the foreign employer if they operating through a PE in South Africa. So again, where is that employee tax resident? Are they tax resident in a country where there's a DTA? Are they going to be somehow, if they're here for less than 183 days, for example, and the salary costs aren't recharged to PE in South Africa, will they enjoy treaty exemption or treaty protection, so that income's not taxable in South Africa? So again, something to consider. And again, a common theme that's going to come through in all of this is it's really important that they get, the foreign employer and the employee for that matter, get specialist advice in terms of understanding what the implications are for them if they do have employees coming to South Africa. So from the employees' perspective themselves, it's important that they also understand what they will be taxed on if they are taxable in South Africa. Typically, as a non-South African tax resident, assuming that they are, they'll only be taxed on South African sourced income in South Africa. And in the case of salary income or income for services rendered, the source of that has been held by our courts to clearly be where the services are rendered. So if they're rendering the services in South Africa, the source of that income is South Africa. So we, first instance, have taxing rights on that income unless there's some sort of treaty protection. And so it's important that is considered. So where the employment contract is entered into, where they are paid from, into which bank account they're paid, whether it's a foreign bank account or any other bank account, is irrelevant. The only issue from a South African perspective is where are they rendering their services. If it's in South Africa, they're taxable here. So again, allied to many of these issues are allied to the situation from the employer's perspective. So will their salary costs be borne by a permanent establishment in South Africa? If so, the treaty won't protect them, and so they'll be taxable from day one. If they in fact tax resident in a country that doesn't have a treaty with South Africa, then again they're going to be taxable from day one in South Africa in principle. And again, is the employee tax equalizer to the extent that they are taxable in South Africa? who's going to pick up that tax cost, the employer or the employee? And what are the employee's obligations? Do they have to register with SARS as a taxpayer? Do they have to pay provisional tax? So there are a number of considerations there. And again, common theme, get advice before employees go out, and get advice before anybody comes in, so that everybody understands exactly what their rights and obligations are as far as these arrangements are concerned. That's it for me. So thanks, Anaz. Back to you.
Thanks, Barry. This is definitely a topic that all employers and employees need to become comfortable with, and quickly too. Our last topic for today is something that most people seem to put off: succession planning. And Dion and Annika are going to tell you why you shouldn't delay this any longer, and also give you some key things to think about. Over to you guys.
Thank you, Anaz, and good afternoon, everyone. Thank you for joining us today. My name is Annika, and here with me is Dion, our resident expert in wealth management and succession planning. I want to dive right in. So Dion, could you perhaps please explain exactly what succession planning is?
Thank you, Annika, and good afternoon, everyone. Succession planning is all about preparing for the transfer of property, business interests, and other assets from one generation to the next. It's about setting up the right mechanisms to ensure these assets are transferred according to the owner's wishes. The process aims to be efficient from a legal, tax, and financial perspective, making sure that everything is in order and runs smoothly. It's essentially a way to make sure that the transfer of assets happens as intended, with maximum efficiency and clarity.
Thank you, Dion. And why exactly is succession planning so necessary?
Well, succession planning is essential for several reasons. Firstly, it provides clarity and direction, which helps reduce the potential for disputes among creditors and beneficiaries. This clear guidance ensures everyone knows what to expect and helps avoid conflicts. Secondly, succession planning protects and preserves wealth. It ensures that assets are passed on efficiently and without unnecessary erosion, benefiting future beneficiaries and generations. A well-structured succession plan can offer significant tax advantages. It can reduce the tax burden on the estate, ensuring more wealth is transferred rather than losing wealth to unnecessary taxes. And then finally, succession planning ensures the continuity of family businesses. It helps maintain their value and operational effectiveness, providing a smooth transition and sustaining the business for future generations. In essence, Annika, succession planning is about securing the future, providing peace of mind, and ensuring that wealth and businesses are managed and transferred effectively and efficiently.
That's very insightful. Thank you, Dion. So despite the enhanced compliance landscape, trusts still hold a significant value in succession planning, as mentioned by Megan. So considering this, how can trusts and other entities, both onshore and offshore, be effectively used to grow personal wealth and plan for future generations?
Annika, trusts are incredibly effective tools in estate planning. They offer numerous benefits, including managing and protecting assets, providing a structured way to transfer wealth, which ensures flexibility and continuity for businesses. Using a trust can help avoid the usual administration delays that come with the winding up of estates. Onshore trusts are governed by SA laws, so it's essential to be well versed in local SA regulations. Offshore trusts, on the other hand, are set up in jurisdictions outside of South Africa, often in low or tax-efficient jurisdictions. These trusts aren't subject to the jurisdiction of the Master of the High Court, which can provide a range of benefits. And then, depending on how they're structured, trusts can offer a mix of fiscal and non-fiscal advantages. They can help diversify assets internationally, act as a financial hedge during political or economic instability, protect assets from creditors, or even guard against wasteful spending by beneficiaries or the founder. In addition to trusts, there are other entities like family limited partnerships and private investment companies, which are also valuable for managing and growing wealth. These entities allow families to pool their assets, centralize their management, and benefit from professional oversight. When structured correctly, they can provide asset protection and facilitate tax-efficient transfers of wealth. Ultimately, trusts and these entities which I've mentioned provide a strong framework for growing personal wealth and planning for future generations, which ensures the security and continuity in an ever-increasing and complex financial landscape, Annika.
That's great. And in succession planning, you often hear the term family office. So Dion, is there value in the establishment of family offices, and what role do they play in succession planning?
It's a good question. Family offices have become almost like a new type of financial institution and are much more visible in the world of finance today. Traditionally, they were set up by extremely wealthy families to manage and grow their wealth. These days, more and more people have access to these services, and their use has become increasingly popular. Family offices offer a wide range of comprehensive services, including investment management, estate planning, tax services, and governance-related activities. If you take a deep dive into the world of family offices, you'll find that some even manage private holiday residences, lifestyle assets like private aircraft, yachts, artwork. Some even provide concierge services and handle personnel like household staff, drivers, pilots, etc. The successful operation of a family office ensures that the family's financial affairs are managed professionally and cohesively, seeking to keep the family in control. This structure provides the family with vital information and education, making sure that they effectively stay on top of things, Annika. These family offices can either be a single family unit or a multi-family unit, depending on the needs and size of the family. Single family offices serve one family, providing highly personalized services, and multi-family offices, on the other hand, cater to several families, offering shared resources and expertise. So in essence, family offices play a crucial role in succession planning by ensuring a smooth and professional management of family wealth across jurisdictions, helping to preserve the family legacy and support the long-term financial stability.
That's very comprehensive. Thank you, Don. So could you elaborate on the importance of drafting family constitutions in the context of succession planning?
Absolutely. So a family constitution is essentially a formal document that outlines the family's vision, values, governance structures, and policies regarding the coordination and management of their wealth. It serves as a guidance framework to ensure that all family members subscribe to the code of conduct and are aligned in their responsibilities and goals. As you can imagine, the drafting of a family constitution helps to mitigate conflict by providing clear rules and guidelines on how decisions are made, how disputes are resolved, and how family members are expected to behave and contribute contribute to and benefit the family wealth. It fosters a sense of unity and shared purpose, which is crucial for long-term preservation of wealth and perpetuating a family legacy. This is often vital for ensuring the continued success of a family business, especially when considering very young family members who might have very little business experience. A lot of guidance is often required, and a well-drafted family constitution provides that necessary structure and support, helping to ensure that family businesses thrive across generations.
That's very informative, Dion. So just to recap some of the key points, succession planning is about adequately preparing for the transfer of wealth and assets, and it is necessary to avoid disputes, preserve wealth, optimize taxes, and ensure business continuity. So I recall you mentioning trusts and other entities can be used both onshore and offshore to manage and grow wealth. And family offices provide comprehensive wealth management services and facilitates generational wealth transfer. And then finally, drafting a family constitution ensures alignment, it reduces conflict, and it fosters unity among family members.
Exactly. Succession or estate planning is about creating a legacy that lasts, ensuring that future generations are well prepared and that the family's values and wealth are preserved.
So as we wrap up, Dion, could you highlight any recent developments in succession planning that may be of interest?
Sure. Trusts still provide crucial benefits like asset protection and flexibility, but their structures are certainly evolving. With the recent changes to the Trust Property Control Act, there's now a requirement to keep a register of beneficial owners and to file this information with the regulatory authorities. This increased scrutiny, particularly on business-related trusts, has led to better governance practices. Certainly, these changes do add, administrative burdens, but they also help maintain integrity and legitimacy of trusts. And despite these challenges, trusts still continue to offer significant benefits like creditor protection, preserving wealth across generations, and flexible asset management. Also remember, Annika, that the push towards greater transparency certainly aligns with global standards, which enhances the credibility of SA trusts in the context of international financial planning.
That's a valuable update. Thank you very much, Dion, and that's it from us. I'm going to hand back to Anaz.
Thank you.
Thank you both very much, and thank you to everybody. That concludes the session for today. As always, we hope you found something interesting, informative, and thought-provoking in the session, and we hope to see you at our next Tax Masterclass. Have a good afternoon and bye-bye.